Hey folks, we're doing a little audio experiment for your listening pleasure on this Friday. Now I can't hear anything, Greg. Welcome, folks. Doing a little audio experiment for your listening pleasure this Friday. Greg, are we going to do the whole song? It's a long song. Would you like to begin, Greg?
I was trying to be all professional. Yes,
I know.
Let's go. You know I'm not good at that.
Oh, it's okay. It's okay. Well, let's kick into the professionalism, and then you know it's your show, which is of course professional.
Oh, of course.
I will say, folks, that this is Tim Serantonio from Neon One, Director of Strategic Partnerships. I want to welcome you on this Friday afternoon or potentially morning where you are. If you're just tuning in or we're tuning in, we were testing out, playing some fun music to get you excited and pumped for PPP loans, getting loan forgiveness and QuickBooks tracking. Greg always brings a new shade of something I need to think about how to do for webinars every single time we do a webinar. There's always a surprise. So thank you, Greg, for keeping me on my toes.
Oh, of course. I'm sure you meant that not facetiously in the least.
No. I've learned to roll with it. So,
all right.
So I'm really excited to welcome all of you today. Just a few housekeeping items before we hand over, because this is jam-packed with information. And this is going to run about 75 minutes or so. Greg, I hope you got that email.
I did.
Okay. So, but we did include the full handout because there's so much information that's so vital for your nonprofit to engage. So we are recording this. There is a handout, and we do have some staff members from both Greg's team as well as the Neon One team on hand to help with either technical issues or you know, you want to ask a question or something like that. Because last time we did the PPP loan one, like lots and lots of questions. So Bill, looking forward to helping you facilitate that. Just before we start, a little bit about Neon One. This is our continuing education series as part of our NPO's Rise campaign. that was originally launched around the coronavirus pandemic to just kind of help organizations survive and thrive. So if you go to neon1.com, we're continuing to add to that. We are going to be rolling out some resources relating to diversity, equity, and inclusion, Black Lives Matter, for instance. Thank you very much. If you hit let's go, that's kind of where the campaign could be kicked off. And also, if you scroll down a bit, we also do have some other upcoming, a little bit more, tiny bit more. We have a Giving Tuesday Action Center, but right here, join the virtual discussion. As you can see, today is PPP loans, but our next webinar is on optimizing moments in your fundraising cycle. And then we have launched our, what is that?
It's me giving you the, I'm
Oh, I
giving
can
you this.
I can move it. Oh,
No,
so,
I can't.
Oh, okay. So, oh, that's nice. So that, and then our generosity. Yeah, man, you're continuing the hits of new stuff to learn. So, and then probably most importantly is our generosity exchange. Our virtual conference is happening August 3rd and 4th. We have a lot of amazing content lined up for that. You can get your tickets, early bird tickets today. So go ahead and save your spot. It's going to be great. There's going to be a lot of amazing things happening there. We're going to be rolling out the speakers and content, but we're going to have a lot of fun things. We're going to have like trivia. We're going to have different debates. We're going to have drill downs and hear from case studies from different change makers in the industry. So pretty excited. And we have some confirmed speakers at the bottom as well. But one of my favorite speakers to hear from, though, Gregg Bossen. So Gregg, we got a lot to cover today, so I'm balls in your court.
All right. So this is me. Can I see the chat? I'm looking at chat. Can the attendees use the chat, or do they just need to use the Q&A?
I think they have to use the Q&A.
All right.
So
no big deal.
That's why Bill is here. He's going to help do that because you always ask yes and no questions. So.
All right. Okay, cool. So I am a CPA. For those of you that haven't seen me teach before, I specialize in nonprofits. We do probably 30 or so audits of nonprofit organizations. We also do a couple of 100 990s, and we have a few hundred nonprofits that we help across the country with technical support. I also despite, in addition to the accounting firm that I have here in Atlanta that again just specializes in nonprofits, we also train and support nonprofits using QuickBooks through a company called QuickBooks Made Easy for Nonprofits. We have streamable training, we have nonprofit technical support, we have live seminars and webinars. We have a webinar that's coming up next week and one the following week, but let's go through the class first. Then at the end, I'll show you if you decide you like how I teach and you want to come to the webinar series next week to learn everything you can about QuickBooks and nonprofits, then we'll do it then. So can everybody just chat whether or not you can hear me, like I'm too loud, I'm too soft, or I'm just right? And put that in the Q&A so that Bill can see it. And then Bill, if you could let me know, before I babble on, I'd like to know people can hear me all right. So what's it looking like, Bill? Bill? I'm not
Bill's
hearing
Bill's muted. We can hear you.
Can you unmute yourself, Bill? Bill seems unable to unmute yourself. Can you see the Q&A then? Tim, can you see the
Yeah,
Q&A?
we're good. Everybody says you sound good. You sound
fine.
Okay,
cool. All right.
There's even a Bill in there who said yes. So thank you, Bill.
Okay,
Patty.
cool. Bill, get it together. All right. So this is not your normal webinar. Okay. I'm gonna require you to shut the door, to turn away from your email, to not look at Facebook, to not let anybody talk to you. Don't answer the phone. Don't even go to the bathroom, because I'm going to tell you now every single solitary word that I speak is going to be important, because we're going over PPP stuff and how to get forgiveness. There is a lot of information, so I'm going to wait to answer questions until halfway through. Halfway through, I'll take some questions. We're also going to take a break halfway through, because who wants to sit for 75 minutes? You know what I'm saying? The brain can only absorb for about 40. and then you're done. So if everybody is ready to go, here's what we're going to cover. So the agenda, we're going to do a quick overview of what a PPP loan is and the fact that it's forgivable. But I just want to go over that real quickly. That's only going to take a few minutes. We're going to spend the majority of the time talking about how to make it forgivable, all of it or a portion of it. The law just changed last Friday. And so now the rules are a bit more flexible to get forgivability. I know you've heard some of it, but we're going to get into the details. We're going to tell you what documentation you're going to need when it comes time to prove how you spent the money. And then we're going to talk about how to track it in QuickBooks and why we want to track it in QuickBooks. So let me just go over, in the interest of time, I'm going to go over this first one real quick. Okay. So this is the overview of the Payroll Protection Program. What is it? It is a loan. Who do you get it through? You do not get it through the SBA. You get it through your bank. And by the way, I will tell you that there is still, as of yesterday, over 100 billion. Tim, can you believe this? There's over 100 billion of dollars still left over that you can use. So if you're a nonprofit or you know a nonprofit that hasn't accessed the PPP loans, you can do it. I know everybody was freaked out that the money was going to run out initially, but not now.
So yeah, so what happened? Did they just kind of figure it out and they got things streamlined? Because last time when we were talking, a lot of people were like hit or miss.
Yeah. Well, you know, they had the first round. All that money was gone instantly. The second round, it was slow to get started. They figured it out. And then honestly, Tim, I think everybody just was like, you know what? I'm sure the money's gone. I'm not going to think about it anymore. I mean, I had a client yesterday that was like, what? I can still do it? And she applied yesterday. Now, the reason why I want to tell you this is the interest rate is 1%. Used to be for 2 years. Now it's 5. We'll get to that in a second. But the interest rate is 1% for 2 years on existing loans. So even if you don't get it forgivable, it's still a heck of a good deal. You get 6 months before you have to start paying it back. The loan length, again, it's 2 years for 1%. Then you can refi it for another 8 years at up to 4%. Are there closing costs? No. You can use it for, now let me just be honest, payroll, rent, mortgage interest, and utilities. But to be honest with you, if you use it for something else, ain't nobody going to worry about it. You won't get it forgiven, but if it's under $2 million, the SBA is not going to worry about it, okay? You just got to pay it back. Do I need to guarantee it? Nope, you don't. Now, the law changed on new loans, so that means loans that you hadn't signed yet, it's 1% up to 5 years. I'm just going to, and then after 5 years, you refi for another 5 years. Let me just make sure you understand here. If you already have a PPP loan, you already signed a document, you're stuck at 1% for 2 years, but on new loans, it's up to 5. Now, I will tell you, existing loans, the bank may decide to change the terms and give you 5 years instead of 2, but it's up to their discretion, all right? The big thing about this is that it's forgivable, all right? One nagging question has been answered. It was when they came out with this loan initially, you had to sign something saying that you promise you needed the money. And then people didn't pay too much attention to it. And then when they came out with the second pile of money, they added some language saying, we really need to know that you need this money, because somebody in Congress was upset about it. And so, and we were like, look, we don't know whether we're going to need the money or not, right? We didn't need the money then, but we might need it 2 months later. So we were like, there's money and we want it. So everybody just went out and got it. And then there were all these webinars that came out where everybody was all freaked out, like, oh my gosh, we have to prove that we need the money, and you need to have the board meeting, and the minutes of the meeting need to be blah, 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 blah. All that is gone. New rule a couple weeks ago, less than 2 million. As long as your loan is less than 2 million, you are deemed to have made the required certification of need. You are cool. So there's no proof of need if you're under $2 million. Obviously, what we are here to learn is how to make it forgivable and what's the best way to track it in QuickBooks. So I'm going to make it forgivable. I'm going to stop just for a second and ask a question. So our answer, is there anybody that has any questions so far? And it looks like I can see questions in the chat box if anybody has a chat box for me. Or Bill, if you figured out how to unmute yourself when there's a question, you Bill?
Yeah, I'm here. There's no questions yet, Greg.
Okay, cool. All right. Well, somebody give Bill a feeling word, and then we'll move on. I need to know how you're feeling.
Greg, I've just made you an organizer. You should be able to see everything as well.
Yeah, okay, cool. Does anybody have a feeling word they want to tell me? Bill?
No.
Happy,
Oh,
sad?
Nancy's frustrated.
Why? Why are you frustrated, Nancy? All right. So I'm going to go on while we're waiting for Nancy to become unfrustrated. So there are 4 factors that are important in determining whether or not it's forgivable, and we're going to go through each one. First, you had to spend it in an 8-week period. Now that period has changed to 24 weeks, but we'll talk about what that means in a minute. It has to be spent on certain things. These certain things are called eligible costs. 75% has to be spent on payroll, and then the rest of it, the other 25, and that's also changed. Now it's 60-40, have to be spent on certain other things like mortgage, interest, rent, utilities. Now the other 2 things, compensation levels have to be maintained, which means can't be lowering anybody's salary more than 25%. Otherwise, you're going to get penalized. You won't get it all forgiven unless you can bring their money back up again. Same with employee levels. Can't be firing anybody or letting people go. You can replace them, but the employee levels have to be maintained. They recognize that you may not be able to maintain them during the COVID period, so as long as you bring them back up, then you'll be okay. And we'll talk about that. We're going to go through each one of these. Now, the new rule, instead of being spent in a 24-week period, in an 8-week period, now it's spent in a 24-week period. Instead of spending it in 75%, it's now only 60%, and obviously the other 40% has to be spent on other stuff. Now, unlike the previous rule, where it's now 5 years to pay back instead of 2 at 1%, on that one, it was only for new loans. This change is for everybody. It's for everybody's loans. All right. So that's the deal with that. And I want to see if I can click. For some reason, I'm not able to. It's annoying. I can't see. I should be able to see more than I'm seeing, but I can't. So I guess I won't worry about it. Anyway, whatever. I'm not going to worry about it. All right. So those are the 4 things right there. And let's get into the details on them. Okay. Now, the law changed on some of this stuff, and I already kind of alluded to it, but I'll just give you a slide. You used to have 8 weeks, now you have 24 weeks. That's even on existing loans that you've already signed. 75% had to be spent on payroll, now only 60% has to be spent on payroll to get forgiveness. Again, that's even on existing loans. The minimum payback period used to be 2 years, now it's 5 years. That's on only new loans, although the banks might be able to say, you know what, we'll do that too. And then a new rule is you can delay your payroll tax period, payroll tax payments during COVID, during the 24-week period. If you're really hurting for cash, you can delay the payments. I wouldn't suggest doing it, but if you do it, then you owe half of that money at the end of 2021 and the other at the end of 2022, I think. So, all right. Now, when I say it's 24 weeks, I lied to you. It's actually the earlier of 24-week cover period or December 31. So basically, if you got your loan already, you count 24 weeks from the day you got your loan. That's when you kind of have to have the money spent. If you get your loan after June 30 and you count 24 weeks and it's after December 31, 2020, then you've got a shortened period. You have to have it spent by December 31. 2020. Does that make sense to everybody? Somebody chat me up. Somebody tell me that yes. Judy said yes. Ooh, I can see now. I can see clearly now. I want to make this bigger, but anyway, all right, let's move on. All right. Okay, getting forgiveness. Now, one thing you need to understand, it is not an all or nothing game. It's not like you have to be perfect. If you don't spend all the money in 24 weeks, if you don't spend 60% on payroll, if you don't keep the pay rates the same, if you don't keep all the same staff, you can still get forgiveness. You're just going to get a reduced amount forgiven, and we'll talk about that. All right. So again, here's the 4 factors. You got to spend it in 24 weeks. You got to spend it on eligible costs, 60% on payroll, 40% on other stuff. You have to maintain the compensation levels. We'll talk about what that means. And we have to have the employee levels maintained as well. Okay, we'll talk about that too. I'm going to talk about just these two factors first, the time period and the eligible costs. And first, we're going to talk about them as they relate to payroll costs. Then we're going to talk about them as relate to other costs. But first, we're going to talk about them as it relates to payroll costs. Now, I'm going to pause just for a second because I know there's a lot of information here. I've already given you some. I'm really going to get detailed now. Want to make sure that you're ready for this. Your head's screwed on straight. You ready? Let's roll. So we're going to be talking only about payroll costs right now, and only about what the time period is that you can use them for, okay? Not other things like what the payroll costs are that can be included. Don't ask me about that yet. All I care about now is time period. So the time period is a 24-week time period. Now, the way it initially was understood was that you had to have paid the payroll and incurred the payroll during the 24-week period, beginning the date you got the money. Beginning the date you got the money, which freaked people out because they're like, wait a second, that doesn't match my payroll period. I'm going to have to prorate payroll? Part of the first payroll may not count. Let me give you an example. Say you got your PPP money on May 8th. Well, according to how it was initially understood, only the money spent after May 8th and incurred after May 8th can be included. Your next payroll is May 17th for a period of May 1 through May 12th. Well, I got the money on May 8th. I guess I can only include the money from May 8th to May 12th. So I got to prorate this when I'm trying to ask for forgiveness. That's crazy. And so, new rule, the payroll costs can be either you date the day you got the money, which is called the payroll covered period, or if you don't want to do the proration, it can be the first day of the first pay period after you got the money. Notice how the date that you pay them is irrelevant, okay? It's the first day of the first pay period after you got the money. This is called the alternative covered payroll period. And when you're filling out your application, you actually check which one you're going to choose. You can't choose the alternative one unless your pay period is biweekly, which is something like every other Friday or more frequently. If you pay twice a month, you can't do the alternative payroll cover period. If you pay monthly, you can't do the alternative payroll period. You have to do the regular covered period. But if you're biweekly or more, then you can do the alternative. So let's just use an example. And I'm going to test you here. So I do want you to give me an answer. So got the money on May the 8th. The next payroll date is May 17th. For pay periods, the next payroll is May 17th for pay period May 1st through May 12th, okay? When would be the next, the beginning of the 8-week period? If you're going to use the alternative payroll period, what would be the next date you would pick? And somebody can just chat and answer. If you're using the first day of the next pay period after you got the money. And I can't see for whatever reason, I can't see the answers. And so Tim, can you tell me what they're saying? If anybody.
Let's see. The 13th, May 13th.
That's right, May 13th. Good for you, because May 17th is an irrelevant date. That's just a date you paid them. It's the first day of the first pay period after you got the money. You got the money on May 8th, so you'd start May 13th if you want to use the alternative pay period, okay? Now, this alternative pay period is only for payroll costs. It's not for other costs like rent and utilities. It's just for payroll costs, okay? The other thing that was weird about this is that they forced us to incur and pay the payroll in order for it to be forgivable. It has to be both incurred and paid during the 24-week period. Now that's weird. Incurred and paid? That would mean the only way to get the money forgivable at the end of the pay period is that you'd have to pay people through the last day of your covered period. You have to pay them on the last day for the last day. Nobody does that. You pay people like for the pay period that ended a week earlier. But they're saying we have to incur and pay it during the 24-week period. So that was just weird. And so They changed that, and now the very last payroll that's during your 24-week period, you can pay that after the 24 weeks is over, okay? And it'll still be included for forgiveness, even though you pay it after 24 weeks, okay? So now you really don't need to do any proration. You can just use the alternative payroll period, unless you are semi-monthly or monthly. Then you will have to do the first payroll. You'll have to prorate that first payroll. So anyway, so that's basically the deal with that. Now, what we don't know about this 24-week period, this is really important, so listen up. Before, we had 8 weeks to use it. Now we have 24 weeks. Can we ask for all 24 weeks of pay to be forgiven? Or can we only still ask for 8 weeks to be forgiven, but we can now pick which of the 8 weeks from the 24 weeks of time we can choose? So in other words, I mean, if you can pay, if they gave you 2.5 times payroll, 2.5 times monthly payroll, and now they're giving you basically 6 months to use it, and you can use it for the whole 6 months, then everybody's going to get forgiveness now, provided you don't fire a bunch of people and don't replace them or whatever. I mean, that's just crazy, but we don't know the answer to that question yet. We're waiting. Okay, nobody knows. Okay, so let's talk about eligible costs real quick. So here's what eligible costs are. There are payroll costs and there are non-payroll costs. So payroll costs, we're going to talk about those first. So, oh, by the way, a couple of questions. Yeah, in order to get forgiveness, you have to spend 60% at least on payroll and 40% on non-payroll. Now, the first question is, do I have to spend 60% on payroll costs to get any forgiven at all? No. You just get a reduced amount forgiven. Remember, it's not an all or nothing game. Okay. Now, if you've been following this, when they passed this change in the law a week ago, originally it was written that you actually did have to spend 60%, otherwise you get nothing. But they changed that a couple days later. So yeah, you'll get a reduced amount forgiven. Well, what if you spend all of it, more than 60% on payroll, which shoot, I mean, if they let me spread this over 24 weeks, I'm probably not going to need to, I can use all of it for payroll. Do I still get it forgiven? Of course. The goal was to fund payroll. Okay. Now, what do they mean by payroll costs? Okay. Well, what they mean is it's made up of 2 parts. It's made up of cash compensation. I wish they didn't use the word cash. It's really just compensation. It's your gross wages. Okay. And then some other payroll costs. So we'll just stop for a second and look at the screen here. Payroll costs include what you paid them directly and then certain other payroll costs like health insurance, okay? Those are all lumped together and the total becomes payroll costs, okay? So let's talk about what cash compensation means. Cash compensation means gross salaries and wages, gross tips, gross commissions, paid leave, vacation, medical, and family leave, okay? And if you're a church, it includes housing allowances as well, okay? What about extra pay? A lot of times it's like, well, gosh, I have this money. I'd like to give people a bonus, maybe give them hazard pay. Can I include this stuff? What about just a raise? Yes, you can do that. See, the only thing that really matters is the time period you're paying them for, not what you call it, okay? What you call it is irrelevant. You could call it bonus, you could call it hazard pay, you could call it a raise, you could call it Billy Bob, Joe Bob, or whatever. It doesn't matter what you call it. As long as it's for the time period that's in your 24 weeks, you're good to go, okay? So got to be earned during the 8 weeks. Now, here's the poll. Here's a little question here. Actually, this is just a question. You can just give us the answer. Which is not a payroll cost eligible for forgiveness? Overtime, back pay from before the time period, before COVID, bonus pay or hazard pay? Which one of these, or commission pay? Which one of these is not eligible for forgiveness? And you guys can chat and answer, and then Tim or Bill will let me know what you're saying. Then we'll move on.
Most people are saying back pay, Greg.
That's right, back pay. Now, I will tell you that you may have read a Forbes article saying, no, actually, you can do back pay. It doesn't really matter when you're paying it. As long as you pay it during the 24 weeks, you're okay. But when you look at the actual instructions on forgiveness from the application the SBA came out with, it's not clear that that's the case. So I like to be conservative, so I wouldn't include it, okay? Cash compensation, so we talked about that. One more thing about it though, it's limited to less than $100,000 annualized per employee. What does that mean? Basically, anybody who makes more than 100,000 K in the prior year, 2019, they are not going to give you money to pay that person in excess of annualized 100K. So if they make 130,000, they're only getting 8 weeks of or 24 weeks of 100,000. They're not going to fund their full salary for forgiveness. Okay, so it used to be just 8 weeks of pay. So you take 8 weeks of pay. So 8 weeks of pay for someone making 100K or more annually. The amount forgiven is capped at, so they kind of figure out what 8 weeks of pay is for someone making 100K, and then they won't let you forgive more than that. So 100K divided by 52 weeks is $1,923 a week. Multiplied by 8 weeks equals $15,385. So the application as it stands now says anybody you ask forgiveness for, you can't ask for more than $15,385. But of course, now they've extended this to 24 weeks. Now, if you can give them money for 24 weeks now, then the max would be $46,155. But I don't know whether that's going to happen yet, because again, I don't know whether you have 24 weeks, but you only can ask for 8 weeks of pay to be forgiven, or can you ask for the whole 24 weeks? We do not know that answer. Okay. All right. So let's see. I'm going to move on to other costs, but I'm going to stop for a second. Does anybody have any questions? Because I feel like that was kind of confusing. How's everybody doing? Is everybody okay? Timothy, Bill? Hello?
Hey,
We're
Greg.
great. We're great.
Are you learning, Tim?
Oh, I'm learning everything.
I thought you already knew everything.
No, not this.
This is the last thing. Once you learn this, that's it. You'll know everything.
Oh,
right.
I've achieved the final boss.
Yes, you are.
Okay.
All
Keep
right.
it going. Keep it going.
All right. Okay. Other payroll costs. So employer paid health insurance, retirement, and state tax. Now, the thing that people don't know about this, first of all, this is not your other costs. We'll get to that in a minute. This is payroll costs, and it's employer paid health insurance, retirement, and state tax. I think I'll say it again. Employer paid health insurance, retirement, and state tax. Okay. So it's only the employer's share of health insurance and retirement, and the only employer tax that's paid is state unemployment and maybe disability you pay to the state in a state like California. So not any other state tax, okay? So let's give you this little example here. Pay stub, $2,500, federal tax, FICA, state tax, health insurance, 403B. So this is the person's net pay, $1,500. Their gross is $2,500, the net's $1,500. In this example, the employer pays nothing towards health insurance. The employer pays nothing towards 403B. What's eligible? $1,500, $2,500, or $2,850? What's eligible for forgiveness? Anybody know? You can chat and answer.
2,500. I see
That's
a 2,500. Right. Yep.
That's right, 2,500. Same example, only this time the employer matches 200 of the health insurance for a total of 350 they pay to the health insurance company, and they match 200 of the 403B for a total of 400. Now the answer is these three. Now the answer is 2,900. All right. So hopefully that makes sense. Now, There is an actual loan forgiveness application that, of course, is now obsolete because they changed the law last week. So they're going to have to fix this. I think the new application is coming out next week. Doubtful you're going to be filling it out anyway because the bank's probably going to have their own version of this application. All right. But it's a one-page application. And if you're a geek like I am, you can go get the application, take a look at it. It's only one page with a bunch of back schedules and instructions, but you fill out your name and stuff like that. This is the payroll costs, and you give this application to your bank once it's completed. But that's where you put all the payroll costs, and that's going to be the wages for each employee plus the health insurance and the retirement that the employer paid and the state-owned unemployment, okay? Anyway, so there are other costs that are forgivable as well. We'll go through these fairly quickly. The other costs, the time period is the first thing I want to cover. And by other costs, I'm talking about the rent and the utilities and stuff like that. And you may not even need this. If you can get all the money spent just on payroll, then we don't even have to worry about it. But if you need it, so the time period is 24 weeks from the date the loan was received. That whole rigmarole about being able to use the alternative payroll period, that doesn't count for other costs. It just counts for the payroll costs, okay? So it's only when the loan was received. That's the date the clock starts ticking. So theoretically, you should have to prorate your rent and utilities. But honestly, I would say just make sure that you include 6 months of bills. And this is another thing I don't know. I don't know whether you can use this over 6 months total, or do you have 8 weeks? You just pick which 8 weeks in the 6 months you can use it. That's another question I have. We don't know the answer to. But I'm assuming they're going to say you have 24 weeks, in which case just include 6 months of bills. It'll be more than your 40% of your loan, so it shouldn't be an issue. You can kind of tell it's going to be easier to qualify. Okay, it really is. What they mean by other eligible costs, non-payroll costs, now they wanted to make sure these are costs that you already had in place by the beginning of COVID, 2/15/2020, before COVID. So in other words, like rent is one of them. They don't want you to get the COVID money and then run out and get a nice new lease space. That's not what they mean. They're trying to keep you where you're at before COVID. They're not trying to make you better, okay? And so that's why this stuff I'm going to tell you had to be in place by February the 15th. So mortgage interest, both real and personal, business, which means real would be like your space, but it also includes a storage facility. It also includes the lease. If you have a mortgage interest on, I kind of confuse this with rent. We're talking about mortgage interest right now. So it'd be the mortgage on your actual space that you're in, but it can also be a mortgage on, I don't know, a tractor or a tower that you have, something like that. That is included as well. Rent or lease payments, that's also on the space that you're in, but it's also including other business property like your copier that you're leasing, your phone system that you're leasing, your computers that you're leasing, the postage meter that you're leasing, your phones that you're leasing. I would think you'd include that as well, okay? Utilities, now this is trippy. Utilities includes gas, electric, and water. You figured it would do that, but it also includes telephone. Yes, it includes your cell phone monthly bills, and it includes your internet bill, and it includes transportation. Meaning, if you have any company-owned vehicles or buses or cars or trucks or whatever, it can include the gas, not repairs, but the gas. Now, I, Gregg Bossen, think you should also include ride shares like Uber, Lyft, and cabs, okay? All right, so and again, the time period starts when you got the PPP money deposited in your account. You start with the payroll costs, you add the mortgage interest, you add the rent and lease pay, you add the utilities, and then you get a total. So we're going to take a little break here, and I'm going to go ahead and play a song, and I'll just put this up here. You don't have to launch a poll. Oh, I guess we do have to launch the poll. I want to know, what do you want to hear? Chains of Love by Erasure, Overjoyed by Stevie Wonder, I Put a Spell on You by Nina Simone, Locomotive Breath by Jethro Tull, and then Mrs. Robinson by Simon and Garfunkel. So
if this is anything like our lovely other musical overture,
So
No one's
can you
going
launch?
to hear anything.
Can you launch? Oh, were you could they couldn't hear anything?
Well, I mean, it was in and out. It was in
Yeah, it
and
was
out.
kind of
But,
lame. All right, well,
right. Well, you know what? We're going to try it. Cue up Mrs. Robinson because that's what's in the lead.
all right, okay. I'll cue up Mrs. Robinson, and I want you guys to go to the bathroom now.
Yeah, we're going to take a 2-minute break. Gregg's got a lot of content. This is a 75-minute webinar, so.
All right, we'll be back in a couple minutes.
Well, that was lovely, Gregg.
I know you can barely hear it. You can barely
And it was
hear
better
it.
than the first time, I
Oh,
will
good.
say. Yeah.
All right. All right.
I
All
actually
right,
heard what they were saying. It was just sad because when you did Bohemian Rhapsody, like just when it hit that like like it cut out, like you couldn't hear it.
Is that your favorite part?
It is. And just a reminder, folks, there's a lot of information. This is going to be recorded. This will be available, and definitely we'll be sending things out so people can see it. But Gregg, let's dive back in.
Okay, cool. All right. So the next thing that you have to worry about goes back to payroll. And this is a requirement that your compensation levels are maintained. So basically, the goal is to encourage you to keep your staff at or near the pre-COVID levels, all right? So you measure this by comparing what you were paying them either per hour or what their salary was before COVID to whatever their pay rate was during the 24-week period. And I know the pay rate may have changed, so you just average it during the time period. So you're comparing two time periods. Now, the specific time periods that you're comparing is you're going to compare the pay rate per person from before COVID, which was basically the first quarter of 2020, and you're going to compare that to what your average pay rate was per person during the COVID period, during 24 weeks, okay? Now, if you reduce their salary more than 25%, then you're in trouble, unless you raise them back up by December the 31st of this year, all right? So the reduction is literally equal to whatever the amount you reduced them by past the 25% during during 8 weeks is what they have now. So let me show you how this works. Again, if you raise them up by December 31, you don't even have to worry about it. Also, this rule doesn't apply to anybody that made over 100,000 last year. So if they made more than 100,000 in 2019, you can lower them like crazy. It's not going to work, not going to bother anybody. Okay. So I'm just going to kind of compare. So watch very carefully. Here's Jane. During the pre-COVID period, her salary was 75,000. During the covered period, her average salary was 80. She didn't make less than 75%. She made more. We gave her a raise. And this kind of answers those of you who say, can I give somebody a raise and have it count towards forgiveness? Absolutely. And you're not going to be penalized. Okay. Sam was at 40. We lowered Sam down to 30 during the COVID period. We lowered him 75%. Is he in trouble? Are we in trouble? Are we going to get a reduction because we lowered him 75%? What are people saying, Tim? Are we going to get a reduction?
Are we going to get a reduction? People say both. Yes,
Right.
no, more than 75%.
Yeah, it's got to be more than 75% before you get hurt. This was only 75%, so you are okay. It's a trick question. Now, Bill was 30, lowered him to 20. That's a 0.66, so that's a bigger than 75% reduction. We got a problem here.
Bill, what are you doing? What are you doing,
Yeah.
Bill?
Well, nothing. That's what he's doing. Absolutely nothing. That's why I lowered his salary. Bill?
Yeah.
All right. So Jenny, $20 an hour, lowered her to 10. That's a 50% reduction. So she might be a problem too. Now, do you see how it's not like they don't lump all these together? You figure it out individually. It's not like you can offset one with the other, like at least for purposes of figuring out what the reduction is going to be. So like Bill and Jenny, those are the two ones that are problems, okay? But we have that rule where if you have them go back up in pay by December the 31st, they're going to be okay. So I'm just going to click through this real quick and just show you. So Bill, let me get my little arrow. Bill, he failed, right? He was at 0.66. So then they say, okay, well, what was your salary on February 15th? That's before the COVID period. What was your salary during these 8 weeks? Now, I don't know whether they're going to change this to 24 weeks or not, but it's an average anyway, 20,000. And then they want to know what your salary was at the end of the year. And we see how we raised Bill back up. So Bill is okay. We don't have to worry about him. Now, I want you to understand how weird this is. You could keep Bill at a low salary all year long. And then the way the test works, on the last pay period of the year, you could raise him back up to 30,000. You won't get any penalty. And then you could lower Bill back down again in 2021, I assume. Anyway, that's the way that it works. Kind of weird. Now, Jenny, we didn't raise her back up. We raised her back up a little bit, but we didn't raise her back up. She was at 20. We lowered her to 10. We raised her up to 12, but we didn't raise her up enough. Because we didn't raise her up enough, she's a problem. We're going to get a reduction on her. Now, the way you calculate the reduction, and it does this for you, You basically, let's just make sure I follow you. I want you to follow her hourly wage. And I do want to stop for a second. This is simply trying to figure out whether we reduced her hourly wage or the hourly or the person's salary. It doesn't matter how many hours she worked. If we lowered her to, if she worked 1 hour in a 3-month period, it doesn't matter, okay? All we're doing is figuring out whether her pay went down. If you're wondering about letting people go, we're gonna get to that in a second, okay? But anyway, so we reduced her from, we were allowed to reduce her from 20 to 15 without having a problem. We reduced her to 10, that's $5 too much. Now, the way that they figure out what your penalty is gonna be is kind of weird. What they do is they want you to tell them what the average weekly hours she worked during the first quarter of 2020. They want you to tell them what the average per week she was working. So we'll say 20 hours a week. Then they're going to multiply that times 8 weeks, okay? Now, I don't know if they're going to do that by 24 now or not, but they're going to multiply it by 8 weeks. That's a total of 160 hours. They're going to multiply that by the $5 excess reduction. So your penalty is going to be $800. So you're going to get an $800 reduction. And right on the form, let me show you what this looks like. Here's that form we were looking at. You have your payroll costs, subtract or you add mortgage, rent, utilities, then you subtract the individual salary reductions per employee. Now, I want to point out something to you. This subtraction's only $800 because that was the only employee that we reduced and didn't raise back up. But when you do payroll costs, it's all the employees added together, and you can give somebody a raise. So even though you individually figure out what the reductions are, you could conceivably just give somebody an $800 bonus, and then it offsets these two. This one offsets the increase, so you end up at the same place. You won't get any problems with the forgiveness. Kind of unfair, but that's kind of what the dealio is. So now the last one is employee levels maintained. Now, I'm going to stop just for a second and see if anybody has any questions. How's it looking? How we doing? Anybody? Is anyone listening to me? Bill?
Well, I mean, there's some questions here. Let's see.
Yeah, read them to me.
Okay. Let's see. Oh, goodness. Okay. Anne says, we pay disability insurance, not a payroll deduction, once a year. Do we prorate to match the 8-week payroll for forgiveness?
The disability insurance is only good for forgiveness if you're paying it to the state. If you're paying it to an insurance company, it's not deductible. If you're paying it to the state, then you would prorate, but it's probably not, because usually if you pay to the state, it's not once a year. Next question.
Okay, Judy asks, if your covered period ends in October, does 12/31/20 still apply for the end time?
Isn't that weird? So that's another question I don't know the answer to, but yes, supposedly the 12/31 is supposed to be the end time. Now you can opt to keep your 8 weeks, but if you end up at in October and you're done, supposedly from what it looks like now, you're going to have to wait to even file to get forgiveness. And then that means, I guess, you still have till December 31 to get your compensation back up and to get your employees back up. But we don't know. They may change that rule next week. We're going to send you out updates because you came to the webinar. So do we got any other questions?
Well, Rebecca asked, what about workers' comp?
Workers' comp is not included.
Okay.
I want it to be included, but it's not included. Okay. So let me just point out one thing real quick. This will be my little sales pitch. So we are doing a webinar, 3 days. It's 2 hours a day. So you get to babble on and listen to me babbling on for 3 days, 2 hours a day. And it's for people that use QuickBooks for nonprofit organizations exclusively, okay? June 16th, 17th, and 18th, which is next week from 2 to 4, it's for the desktop users. And from the 23rd to the 25th, it's for the online users. Now it's 3 days, and I'll click here to register. I'm going to give you guys a huge discount because you came to the webinar. You simply go to quickbooksmadeeasy.com, you click on courses and training, you click on webinars, and it's the 3-day series. We only do this twice a year. It's very, very popular. We do it once for people that are using the desktop and once for people that are using the online edition. And it's 3 days, 2 hours a day. So you get to learn for 2 hours, ask all your questions live like now, then you think about it overnight, and then tomorrow you come back, you can ask more questions. So this is day 1 and everything that's covered. This is day 2 and everything that's covered. And this is day 3 and everything that's covered. In day 3, we really get into tracking pledges, restricted grants, special fundraising against. You can get a thank you letter out of QuickBooks. In-kind contributions, auto allocating expenses. There's all kinds of stuff that's covered. Day 2 is the nuts and bolts of entering transactions and using QuickBooks as a donor database. And it's normally $249. We're going to give it to you for $199. We'll give you the codes at the end of the webinar. Okay, so that's kind of the dealio with that. And I'm just letting you know because this sale ends, well, I don't know, when did we end it? When are we ending it, Bill? Well, I'll ask you in a few minutes. Let me do the employee levels real quick. So the employee levels, so this is the last thing. So I'm just going to rest my voice for a second. And then we're going to talk about the employee levels maintained. And this is the one where you may have the most questions because you got to keep your workforce at pre-COVID levels, which is next to impossible in this environment, right? So just like with the compensation, if you raise your employee levels back up by the end of the year, you'll be okay. You won't have a penalty. But let's just go through this. So the way they're going to measure this is they're going to measure something called FTEs, okay? Full-time equivalent staff is what they call it. And they're going to measure it from before the COVID period to what you did during the COVID period, okay? So just so that you understand what an FTE is, okay? This is basically what it is. 1 40-hour employee equals 1 FTE, all right? So this is a calculation you'll make, okay? So 1 40-hour employee equals 1 FTE, 2 40-hour employees equals 2 FTEs. So you make it for the whole organization. You get 1 total for the whole organization. 1 20-hour employee is 0.5 FTE, and 2 20-hour employees is 1 FTE. Hopefully that makes sense to you. So it's a calculation you make. And what you do is you compare it from before the time period to the time period. So look at this. Faye is full-time. So her average weekly is 40 hours a week divided by 40, 1 FTE equals 1. Okay. Sam's part-time. Sam's 30 hours a week divided by 40. He's a 0.75 FTE. So that's rounded, I like to round up to 0.8 FTE. And then Bill barely works. Sorry, Bill, I keep picking on you. Bill, his average weekly hours are 12 hours divided by 40, 0.3. So his average FTE is 0.3. So see, this is how you make the calculation. What I haven't covered is what time period you make the calculation for, okay? Because you got to make it for before the COVID period to then to the COVID period, okay? So the total for this example is 2.1 FTEs, okay? So let's go ahead and explain to you, you're comparing the FTEs before the COVID period to the COVID period. Before the COVID, well, to the COVID period means what your average FTEs were during the COVID period, to something called a reference period, a prior reference period. And it can be either, and you want this one to be equal to or higher than this one, okay? Because you want to maintain your levels or make them better. The reference period could either be 2/15 to June 30 of 2019. So in this case, you're comparing what your FTEs were basically during the same time period last year to this year. And if your payroll didn't change between the 2 years, then this will be fine. But if you like had a bunch of people last year that were working for you, and then you got rid of them before this year started, you don't want to be comparing. You don't want your prior reference period to be last year when you had some extra program going on, you had extra staff. So then you want to make it this one, so you can choose between the two. So just choose whichever of the two is lower, okay? And then you compare it to the number during the COVID period. So let me just show you. Here it is. So here's the FTE from last year to the 24-week COVID period, okay? So let's see, and I want to make a point here. Sam is one FTE, and he's still there, one. Sally, we fired. People always want to know, what if we fire somebody? Are we going to get in trouble here? Well, first of all, if you replaced Sally with Jay, then your total FTEs didn't change. So that's not a problem. So you can replace people and not get penalized. Jenny, she was at 1, she's still at 1, so is Davis, and so is Alan, that we didn't change anything, so we're good. But look what happens if you do have to reduce employee hours. Sam, we didn't. Sally and Jay, we hired and fired, but Jenny was at 1, we reduced her to half-time. Davis was at 0.5, we got rid of Davis altogether and didn't replace him and didn't ask him to come back. And Alan, we reduced 2. So that goes from 4.3 to 3.0. So we are going to have a penalty here, okay? Unless by December 31, we raise them back up again, okay? But assuming we don't raise them back up again, I just want to show you the effect of this. So basically, you take 8 weeks of FTE, the covered 8 weeks, which I guess would be maybe 24 now, divide it by the prior reference period FTE. So that's 3 divided by 4.3 in our example equals 70%. So what that means is our FTE is 70% of what it used to be. So what that means is we're going to get a reduction. So if we had gotten 100,000 of PPP and we had spent 75 on payroll and 25 on rent, we would have had 100 forgiven. But now we're only going to get times 70%, 70,000 forgiven. So it's a big deal that you want to get your FTEs back up by, it looks like, December 31, okay? So some people have questions like, well, wait a second, this is really crazy because, you know, I can't find anybody to replace the person, or we just don't have the ability to hire somebody new. And so they've changed this rule now. So let me just get right to it. If you got rid of somebody and you made a good faith written offer to them to rehire them and they said no, you're fine. You don't have to include them. You won't get penalized for having lower FTEs. Also, if they were quit or they were fired with cause, then you don't have to find a replacement. You won't get penalized either, okay? New, this is new as of a week ago. Even if you let them go without cause and you didn't ask them to come back, but you couldn't find a qualified replacement, you're still going to be okay, okay? Or if you couldn't restore business operations. So it's like, look, I would have asked them back, but it's just not practical. We're not doing musicals right now. Even though it's December, I can't bring somebody back. Please don't penalize me. They won't. So I think it's going to be much easier to get around this exemption now, okay? Those people can be ignored. So we've got 15 minutes left. This is, I'm not even going to worry about this. This is the documentation. So what'll happen is after your the end of your 24-week period or December 31, whichever happens first, and if you'd want to just hurry up and get it over with, you can stick with your 8-week period. You're going to need to apply with the bank. Now, as I said before, there'll be an application from the SBA that you can conceivably download and fill out. That application today is on the SBA website, and you are to ignore it because it is now wrong. They have to update it. They'll update it next week. Let me tell you something. Teaching PPP is like trying to fly a plane while they're still building it, okay? Everything keeps changing. But anyway, I wouldn't fill out the application on the SBA, even if they did update the application. At first, I would talk to your bank, because particularly the bigger banks, they're going to have their own application that mirrors the PPP application, and it's probably going to be an online application, and you're probably going to have to upload a bunch of documents if it's a bigger bank. This is an example of some of the documents that you can use, and you'll have this in your deck that Tim is going to give you afterwards. So I'm going to teach how to do this in QuickBooks is what I'm going to do next. But I'm going to stop for a second. Does anybody have any questions before we move on?
Oh, Greg, Rebecca has a question. She says, as a nonprofit, we elected to self-insure for unemployment claims. With the PUA $600 federal weekly unemployment pay, the cost will greatly increase. Is this cost for unemployment cost for employees eligible and thus forgivable?
It's not paid to the state. I don't think it is. But it should be. But I don't think it is. It's a good question. What's the next question?
Can employees file for unemployment for the percentage we don't pay them?
No. Either you work or you don't. I don't think you're going to get unemployment for getting a lower amount of pay. I don't think that works. That's why some people will refuse to come back, because they're like, dude, I can make more money on unemployment than I can working at this rate, so I'll just stay unemployed. Anybody else?
Ann says, are you saying we can apply for a second loan once the new app is up?
Absolutely not. You can't, you only get one PPP loan. What I'm saying is, if you haven't applied for a PPP loan at all, then you can now apply for one and get 5 years instead of 2 years. Sorry about that. I didn't explain that correctly. Tim, can you put up that other poll about whether they're using desktop or online? Because I want to see what the breakout is.
Sure. And we did get a question in terms of the Neon CRM sync with QuickBooks. I actually made sure to give that question the direct webinar that we covered it before, actually, which is pretty cool that you and I dove into that. So we have that resource for you. We could definitely follow up with deeper things. Neon has a very deep integration with QuickBooks, both desktop and online. Right now, Greg, it looks like the vast majority, 68%, are using desktop.
Okay, all right, so then we'll go with desktop. I do want to address one thing about the Neon integration. If you are interested in having us help you, if you go to nonprofit services right there on our website, I didn't even think about this. Let's see. This one right here, mapping to QuickBooks. If you're using a donor base and you want to map it to QuickBooks, we've got it covered. So if you click View Service, and we've done this for a number of your clients, Tim. We are doing it right now with Neon or Little Green Light. Those are the only two that we're doing. It's $349, and we will meet with your team, show you how to. We'll go over how to set up things in QuickBooks Online to make sure that it's right, or QuickBooks Desktop to map with Neon. And then we'll sit through a meeting and explain to you how to do the mapping. We'll do the mapping for you, and then we'll teach you how the import works to help you get started.
And Greg himself is a certified Neon CRM consultant as well. Neon One consultant specific to Neon CRM, which is great. So
okay, cool. So
awesome
I'm going to open up QuickBooks Desktop since most people are on the desktop. However, I could just as easily do this in Online Edition as well, but we don't have time to do that. So let me open up QuickBooks if I can get it open. Hold on a second here. QuickBooks. I should have had this open already. QuickBooks 20. All right, so I'm opening up QuickBooks. While I'm opening up QuickBooks, hopefully it's opening, I will explain to you PPP tracking. Now, first of all, why do you want it to be tracked? First thing is so you can understand how you're spending your PPP money. Also to help you get ready to ask for forgiveness. But I'm gonna tell you right now, if you were to track PPP in QuickBooks, and I do think you should, it's not like the bank, you can just give the bank a report and they're just going to be real happy and everything's great. You know, they don't care what's in QuickBooks. They're going to still want you to fill out the application and give them backup. The real reason why you want to do it in QuickBooks is so you don't mess up your grant tracking. Okay, so let me explain something here. Say you have a grant that pays for payroll. Well, now you've got a PPP that conceivably pays for those exact same employees for that exact same time period. You can't use the same exact expense for two different grants, okay? You can't use both a grant and a PPP, which is essentially a grant if it's forgivable. You can't use them both for the same paychecks. So therefore, that's why you want to point expenses to grants to avoid double dipping. And you should be doing this for all of your restricted grants. If you don't do this now, if you don't point expenses to grants, then you should be. I'll show you how to do it. We teach it during the 3-day webinar series, but I'll just show you right now. That's how you're going to do your PPP as well. Okay. So let's see. So what you're literally going to do is when you get the money from PPP, and I know you may have already gotten it, you want to create a PPP loan account. Okay. Make it an other current liability account. Then you deposit the money not to your income accounts, but to this other current liability account. And if you're an online edition and you're downloading deposits, then you, in the download, you point it to this liability account. Then you create a customer in the customer list called PPP loan. Yes, in the customer list. And if you're on the online edition, your list may not be called the customer list. It may be called the donor list or the member list or the client list. You can change that name. But anyway, you put it in there. And the reason why you do that is so you can point costs to the PPP loan customer, okay? Then you can run a report showing you how you spent the money. And let's just go into QuickBooks now. Hopefully, here we go. Let me install it later. So I'm opening up QuickBooks right now. And let me just open up the last data file that I was in. I was just teaching this the other week. So we have like 5 minutes left. Very exciting. How are y'all feeling now? Do you feel like this is a valuable webinar? I'm hoping. What do y'all think?
Are you going to start adding polls onto that?
No. We got
people say yes, absolutely. And okay. Greg, we wouldn't have you on if it wasn't. I mean, this is a very difficult topic to wade through, and being able to actually do this is amazing. So thank you.
I really do appreciate it. So here we are in the desktop. So I'm going to walk you through this, and you can still set this up after the fact. Step 1, you go to the chart of accounts list. We'll go to lists, chart of accounts, and I'm going to go to the bottom left-hand button, and I'm going to click new, okay? And I'm going to create an account. It's going to be other current liability right there. You click continue, and then you name it, PPP loan. I've already created it. I called mine PPP loan Wells right there. Then when the money comes in, you just edit this. In the make deposit window, instead of pointing it, usually I put an income account here, but no, I'm putting a liability account here because it's not mine yet. It's just a loan. Then I'm going to go into my customer list. So to get to my customer list, I'll go to customers, customer center, and here's the customer center. And I click up here, new customer right there. And then we go to, there it is, PPP Wells. No big deal there. So we create the customer. And the reason why we do that is so we can point expenses to it. So I'll go to banking, I'll go to write checks, and a write check window will open. Now, hopefully you understand this. If you don't understand it, you definitely need the training. So watch me very, very carefully here. So we'll say this is for rent. Say it's $200. I'm not telling you not to point it to the expense account rent. You still need to do that. I'm also wanting you to I want to make sure, and this is how all nonprofits do it, or you're supposed to use classes to track programs, admin, and fundraising, okay? Some people use this for your grants, but technically you're supposed to use classes for program, admin, and fundraising. That leaves this customer job field. This is where you point it to the PPP loan, okay? I'm going to go ahead and save this. You do that in the right check window. You do that in the inner bills window. You do that on the bank feeds. If you click on a bank feed, it'll open it up in the online edition. You can add the customer as well as the account. And then I'm just going to do a little report here. Company, profit and loss. I'm going to make the profit and loss be all dates. So this is basically all my transactions. But if I only want to know what PPP money has been spent on, I'm going to click the Customize button at the top. I'm going to click the Filter tab, and I'm going to filter by name. And I'm going to click here. I'm going to click I just want PPP. I'm going to click OK. And now I've got only the expenses out of that $10,000. I've spent $8,770.61. So as soon as you get the money forgiven, then you're going to make a journal entry. I know you might not like journal entries, but that's what you're going to need to do. But you'll need to make a journal entry to move the PPP to income. You're going to lower the PPP liability account by debiting it, and you'll increase government grants, because that's basically what it is at this point. It is a government grant. And let's see, we only spent 8772.61, so 8772.61. We're going to move to income, 8772.61, and now I'm going to save it. And now it looks like that. And when I look at my general P&L, the general P&L is going to have that government grant in it. So that's basically how that works. So one more time, let me go back to my little deck here, wherever the deck is. Here it is. So this is what's covered in day 1. This is what's covered in day 2. This is what's covered in day 3. Here are the codes. It's called Neon 50 off. So if you want to come next week to the desktop series, if you're like, I need to see this in the online, Greg, the whole thing will be in the online the week after next. It's $249 normally. Again, you put Neon 50, it's only going to be $199 for you. 3 days, 2 hours a day. Essentials and beyond essentials. This is on-demand training. Together, there's 16 hours of learning on demand. Normally, they're $229 each. We're giving them to you for $99 each. If you put Neon Spec 99, so if you don't want to learn by going to a webinar, you just want to learn at your own pace, that's what these are for. You'll have access to them for the rest of your life. The last thing I told you at the very beginning of the webinar, we have about 600 nonprofits that call us 24 hours a day, 7 days a week to ask us questions about how to do stuff in QuickBooks. We even dial in, remote in, and we help them. It's unlimited support, $499 normally. You're getting it for $299. It's $200 off. It's called Neon 200 off. All of these offers expire on Sunday at 11:59 p.m. All right. So, and to get to it, you go to QuickBooksMadeEasy.com, okay, which is this site right here. And then if you want, you just click here to get to the training that's next week. If you'd rather do the tech support, you click here, or you can do on demand if you want to do that on demand training, okay? I'm done. So Tim, do you want to take us out?
Yeah, absolutely. And
Okay.
if you ever want to find or forget Gregg's information, if you go to neon1.com, he's in our partner directory. So we curate our partner ecosystem to find the best types of experts to talk about these types of things in our industry. This is why we do this, because no one else is going to be able to drill down as much as Gregg for this type of stuff. Folks, we really want to thank you for coming to the webinar today. This is really impactful information. It has been recorded. Download the handout right now, or you can always email us, or you could email me directly, tim@neon1.com, if you need something. And we have our next webinar coming up later this month. It's going to be diving into the ways that digital fundraising interacts with direct mail. Got some really great folks, Firefly Partners and T. Clay Buck, fundraising consultant, going to do a deep dive with me on all things of that. And then don't forget the Generosity Exchange over in August 3rd and 4th. Let's see if we have any final. How can we download the webinar? So we don't give you a file, but you can definitely view it on demand. We put it on our YouTube channel. And actually what's kind of nifty is if you go back to the registration link, pretty much like almost immediately, maybe 15 minutes, 20 minutes, by the way, folks, if you go back to where you registered for this webinar, or just go to NPO, the neon1.com website for NPO's Rise, you can actually like immediately view it on demand there too, but which is pretty nifty. So neon1.com, go to NPO's Rise, the Let's Go button. You'll probably be able to review this today, but probably by tomorrow, if not quicker, we'll be getting it up onto our YouTube channel as well for Neon 1. Any final thoughts, Gregg?
Well, I want everybody to have a good weekend. Don't get too close to anybody, but I don't know. I think COVID's rising in 21 states.
Yeah, I'm in New York, so we're shifting into phase 3 of our reopening, but I'm not going in any restaurants anytime soon. So
yeah, I've been cooking a lot more than I used to.
Oh yeah, no, I love cooking. Well, hopefully, folks, you have a lovely weekend yourselves. Everyone stay healthy, stay safe, and we're here to help you and to guide you through these times. And so we're going to continue to put out content. We'll be updating our NPO's Rise campaign with a lot of great resources. And our eye is on end of the year. We want to put you in a good spot for that. So that's going to be financially, that's going to be with your community, growing your mission. And so we're going to continue to have content like this. So everyone have a lovely weekend. And it looks like the email will be going out early Monday, but you can always check it out in the wide variety of ways that we provide it in a digital format. So
yeah, and I will say, Tim, that I look for an email from us as soon as they come out with further guidance on the new PPP rules. Look for an email from us. We'll e-blast you and let you know.
Awesome. Very cool. Okay, folks, have a great weekend. We're going to wind it on down. And Gregg, thanks again for you and all your great work.
Cool. Thank you too, Tim. See you later.
Bye.
Bye.